Hello, and welcome to Money Mystery No More. Let's talk about cash flow. Small business and big business have a lot of things in common, and one main thing is both must have more money coming in than the amount of money going out. There can be a lot to know about cash flow in businesses, like having a positive cash flow for their success. If you are a newcomer, this is definitely an important topic, and you will get the most out of it by slow walking the basics of cash flow and then later checking out the assets and the main takeaways. So yes, let's talk about cash flow and how it works for you in business while the fundamentals apply to your personal life by keeping it simple. It's awesome. And remember, hit that subscribe button to keep getting the latest and greatest information. Okay, let's remove the mystery. There are lots of definitions for cash flow, and it can make your head spin. A quick search yields an enormous amount of information with heavy explanations. But really, cash flow is easily understood as ins and outs, or simply revenue inflow versus expenses outflow. It also means taking a closer view of what money is moving in and out of a business, essentially because how that plays out can mean several things. Not always good, but not always bad. It depends. A negative cash flow is what it sounds like. A business spends more money than they receive and bring in. The resulting negative amount is a minus and is the business net cash flow. Just because it's negative doesn't necessarily mean it's a bad thing, depending on the situation. Think of this. Maybe there are big investments for future growth. When that is the case, a company is investing into capital expenditures, also called CapEx, and the money left over is free cash flow, FCF. The investment into CapEx is being done to create shareholder value for the future. A positive cash flow is what it sounds like. A business receives and brings in more money than they spend. The resulting positive amount is a plus and is the business net cash flow. So you see, either way, the business will end up with a net cash flow amount, whether plus or minus for a given period of time. After all is said and done, each specific period of time within an accounting period results in a total net balance that is reported on a cash flow statement. That statement is literally like your checkbook to reconcile things. For a business, it's used to reconcile their balance sheet and income statement. Ultimately, it will show the bottom line of all of the inflows, the revenue received along with all of the outflows, the expenses spent. Similar to your own month-to-month money, it will be recorded as either a net increase or as a net decrease, usually called CCE, or cash and cash equivalents. This is also reported on the balance sheet as a line item to be reviewed month over month because it represents cash and which assets can be converted to cash at any given time as needed. You would think that having a positive cash flow and a standard net increase in CCE, cash and cash equivalents, is a great thing. Perhaps the inflows involve more than normal sales. Maybe there is revenue from investments, interest royalties, or even some licensing agreements. When there are more inflows, money coming in, it may indicate a business is solvent, that they have liquidity and more flexibility. Basically, that they are in good shape now and in the future if things take a turn for the worse or the economy slows down, creating headwinds for the business. On the same token, you would think that having a negative cash flow and a perhaps ongoing net decrease in CCE, cash and cash equivalents, is a bad thing, and it may indicate a business is not solvent, it's in bad shape. Well, you are correct that the health of a business may be viewed through that lens, but cash flow does not always mean what you see is what you get. Snapshots are not always clear, and it's also the reason most money professionals will want to review the income statement and balance sheet as well. As a whole, each is a helpful tool to consider the overall picture of the business health and long-term success. They will want to see how debt is managed and how daily operating expenses are handled. Okay, if you are a numbers type person and just get to see the how-to, feel free to use the formula CF equals TCI minus TCO to calculate the cash flow. CF is cash flow, TCI is total cash inflow, and TCO is total cash outflow. Again, cash flow is simply total cash inflow minus total cash outflow. Realistically, financial opening and closing balances are used as well. Okay, first, start by taking the total amount of cash you have, or the opening balance. And second, figure out the TCI, the total cash inflow. This is only money really received in your pocket, so to say. Then, just add your opening balance to that TCI, total cash inflow, for the total cash balance. Fourth, just like a second ago, you calculate your TCO, the total cash outflow. In this case, only factor money really spent, out of pocket, so to say. Fifth, and like the formula suggests, subtract your outflow from your inflow and simply add the starting balance to reach your current period's ending balance. Yes, it will also be the next period's opening balance, and the process will repeat each period. Sixth, and finally, it's normal to break that figure down by the type of cash flow, which we're going to discuss very soon. After all that chatter, there isn't much more to say except, well, maybe a little bit about how companies use cash flow. It's good to remember that revenue and cash flow are not quite the same thing, just like profit and cash flow are not the same thing. Even though selling goods and services both bring in money, it may be categorized as accounts receivable or as cash flow depending on when it happens. For an example of revenue representing accounts receivable and not yet cash flow, think about expected money from something that is potentially billed but not yet received. Items purchased on credit, for example, or even future services like a subscription or a recurring service schedule. And of course, profit comes into play as what is left, the profit, after subtracting expenses from revenues. Long story short, just remember that revenue is capturing all expected income monies. Cash flow is capturing all actual inflows and outflows, and profits captures what is made and kept. Large companies can provide shareholders some insight into a company's value because they can display how long-term free cash flow may be generated. Long-term free cash flow, FCF, is generally used for capital expenditures, which are typically big physical items like equipment or property. They might be a licensed item or patent as well. Whatever it is, they usually have a longer shelf life, like more than 1 year, and add value to the business efficiencies. A small business isn't that much different, actually. They use cash flow in similar fashion, and more importantly, to show they are running a healthy business, assuming positive cash flow. If it is positive, it demonstrates they pay their bills and can even invest in the future too. At this point, you know a lot more about cash flow, so let's dive into the main types. Each represents sources of business expenses and profits. First up is CFO. You can also call it cash flow from operations, or as operating cash flow. Same thing. It simply shows if a company has enough money coming in to cover their bills or operating expenses. It's all about normal operations and the flow of money involved directly with the production and sale of goods. Inflows come from normal business operations and sales. Outflows come from materials, inventory, overhead expenses, and employee salaries. When operating expenses are paid in cash, they are subtracted from the cash received from sales and recorded on the cash flow statement quarterly or annually. The resulting number is a flag about financing needs or even the ability to maintain current operations or the ability to expand them. Then we have another three-name type. It's CFI, also called cash flows from investing or investing cash flow. In this case, it may not be a red flag if the number is negative. While a positive inflow of cash due to investments is certainly desired, an outflow is recognized as beneficial for the long-term health of the company. Investment inflows and outflows may be from purchase or sale of items like securities, bonds and stocks, research and development, equipment, property, assets, even interest earned on investments. Finally, we have CFF, which is cash flows from financing, or also called financing cash flow. This is a little deeper because investors look at this to understand if the company is managing its capital well and to see the overall strength of the company's finances. Basically, how is cash used to fund the business and the capital of the business? There are transactions involving the issuance of debt, the issuance of equity, dividend payments, investor or creditor payments, or all funds to raise capital for starting or expanding the business. And of course, we could continue on with even more fun-filled formulas, but won't. You can analyze cash flow through a myriad of measurements for a myriad of reasons, but this isn't the video for that. Let's move on. It's definitely been quite a brain overload with cash flow, and cash equivalents. If you use a little table to visualize, for example, some common assets that are considered a cash and cash equivalent, there seems to be somewhat of a theme. Cash and cash equivalents are assets ranging in liquidity, things like treasury bills, treasury bonds, silver, jewelry, CDs, certificate of deposit, precious metals, bank accounts, commercial paper, gold, marketable securities, government bonds, and maturities. Keep in mind that some of these depend on the maturity, restrictions might apply, and then short term, they may be under 90 days. And using the same approach for our key takeaways helps to keep it simple too. Main takeaways involving cash flow include cash flow is a company's movement of money. Inflows represent cash or money received. Outflows represent cash or money spent. The cash flow statement shows the sources and use of cash. Key takeaways for CCE, cash and cash equivalents, include the following items, like CCE is a balance sheet line item. CCE are assets that can be converted to cash immediately. CCE may be used to pay short-term bills and may even be used to preserve capital for later use on big items. Well, wasn't that a blast? By now, you understand more about cash flow than you ever knew existed. You get the ins and outs, or the revenue inflow versus expenses outflow. Take your newfound knowledge and let it benefit you professionally and in your personal life by keeping it simple too. Remember, hit that subscribe button and turn on notifications so you keep getting the latest and greatest information from Money Mystery No More. I'll see you in the next video.